Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from thewealthyhomeowner.ca. Welcome back to the show, Ross.
And thanks for having me back on, Jim.
Ross, as you know, the coronavirus is now being blamed for a global slowdown, and experts are now claiming recessions are highly probable. Is this the fall your data was showing years ago when you announced it on this show?
Okay, so, I figured that this question was going to come up today. So what I did is I went back on your archives on Howe Street, because as of today, that's the only place publicly where our market intel has been provided to the public at no charge. So Howe Street is the only place that we have given access to our information. What I mean to say by that is we turn down pretty much all the interview requests that we have from mainstream media. The primary reason for that is that we cannot kowtow to their demands and try to make things look worse or better than what they are, or agree with the false information that other guests have already been on the record on their shows saying. It's just too much effort, Jim, to go through. So in preparation for today's show, because, we're watching this happen real time. This is the third time in my lifetime that I've watched this happen as a business person. Once in the late 1980s, once in the mid-2000s, 2005 it started. We know what happened and ended up being recorded in 2008. And again 3 years ago here today. Listeners will remember, repeatedly, we say on this show, housing markets give you 3 years advance notice that they're moving towards a correction. We have repeated this over and over again on multiple shows. We have also talked about a recession. The first time we talked about a recession caused by a housing market, based on the record that I have here, is back in March of 2017. Then in August of 2017, September of 2017, October of 2017, March of 2018, August of 2018, November of 2018, January of 2019, February of 2019, April of 2019, and July of 2019. And then we went silent. Why? Because you had 3 years notice if you simply listened to the shows in the Howe Street archives. Now, I understand no one should believe what I'm saying about how you know a recession is coming. How you know a recession was coming in the late 1980s, early 1990s was housing market data. How you knew it was coming in 2005 was housing market data. How you knew it was coming in now was housing market data from 2016, the fall of 2016. How you knew a recession was headed in Australia was housing market data. How you knew a recession was going to hit China, housing market data. How you knew a recession was coming to the UK, housing market data. Every place around the globe where eventually within a 3-year period, recession becomes a new topic. The housing market has already rolled over 3 years before. I don't know in other countries if there's a shorter window. In other words, I don't know if you can get a false positive and then in 2 years and you get a recession. I can only speak to the Canadian and the American housing market. Those housing markets always give you 3 years notice. If you were reading the American housing market in 2005 the way that we were reading it, you would have had your first warning signals of a pending recession. What's shocking? What's shocking this time is that the current state of COVID-19, the current state of it, not many world dwellers are infected. Very few. Supply chains, magically now, are all interrupted. What I believe is this, Jim. I believe that economists, who are the greatest shills and hucksters of our time, as far as I'm concerned, because you have to understand, I'm looking at it from a housing market perspective. I listen to what they say, and it's a bunch of hogwash. So what that means, the Canadians are, during my business lifetime, in the late 80s, early 90s, economists totally missed the warning sign that a recession was coming. When it came, they had to come up with another answer. In 2005, when the next correction was hitting, I'm going to say that, here, the Canadian market was already correcting, but the American market was correcting at the same time. So you had a double whammy of recording data available. And then you have the false claims that came out of the United States about the subprime lending prices. A decade later, research shows that that wasn't true, but economists jumped on it. They got an out. They got an excuse for their incompetence. They got an excuse for their ignorance. They got an excuse why they missed the call. I see the exact same thing happening again right now, live, and I'm no longer selling homes. I'm watching economists around the globe jumping on the COVID bandwagon and getting an excuse why they missed the recessionary signals or metrics over the last 3 years. I am watching politicians breathe with a sigh of relief. Those who are going to are in a situation where they can seek to put blame for the economy on someone else. They've got a sigh of relief. We can blame everything on the COVID virus. The Bank of Canada Pollock, who is leaving his position in June, who is going to leave his position with the Canadian homeowner holding a higher share of debt recorded under his tenure than any other Bank of Canada governor in history, is looking to get an out. Oh, COVID-19. We've got to drop rates 50 basis points. Instead of accepting the fact, hey, I made a mistake. Back in November of 2016, when we tried to raise interest rates, and the OSFI instituted the mortgage qualification rate, which effectively caused interest rates to rise in terms of how much house you can buy. I got a new excuse. I don't have to admit that I made a mistake. The 60 cases of COVID-19 in Canada at the date of the interest rate drop, that's my excuse. There are more people with the flu in the city of Burlington, my hometown here, than there are all of the people in Canada with COVID-19. What is this guy getting away with? What is Bill Morneau and the federal Trudeau government able to get away with? The parties that are fighting against them, they're just as incompetent because they're not calling out these mistakes from the past. I believe, Jim, I believe this is not a conspiracy theory. This is what I believe. I believe that each of the last 3 recessions, the housing markets have forewarned are coming within that 3-year window, were identified as being caused by something else because those who are forecasting no recession are incapable of understanding how the housing market, the cooperative listing service infrastructure in Canada, causes house price illusion, which in turn causes a false wealth effect, which is legally allowed to be leveraged by government corporations in Canada so that Canadians can go out and spend more money artificially supporting the economy. And when that ability begins to decrease, the inevitable recession that is going to result is missed. Now they're going to say, oh, there's 160 cases of COVID-19 in Canada today, or 139, whatever the heck the number is. They're going to blame a recession on a virus instead of their own ignorance and incompetence. There is no reason that Canadian jobs were ever lost to China. There is no reason that the Canadian supply chain ever needed to be turned over, in part, to China. Canadians are concerned with climate change. We didn't want to extract oil from the oil sand. We have protests across the country about climate change. Yet at the same time, we're filling our stores with Chinese-produced goods and services, which require a higher pollution content to be put into the world to get those lower prices. I believe, Jim, that what we're seeing today was recorded on your show 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 times in the last 3 years. The first time we talked about it, it was already almost 10 months after we had recorded. You can have this metric being recorded. You can give yourselves 2 or 3 months notice to make sure the trend is where you believe it's going. And even then, you still get almost 3 years of advance notice to make a decision. I wonder how many of your listeners out there today realize CIBC stock is now paying almost a 7% dividend. Think about it, folks. If you had understood how the housing market works and how mortgage debt is booked, and if you knew how the banks historically have responded to interest rate changes, and how their CEOs historically have utilized the mortgage market to grow their bank's share value, to get their CEO bonuses higher, you would have known that CIBC between 2013 and 2015 was booking the highest share of mortgage debt of any bank in Canada, which naturally prevented its share price from increasing because of its risk exposure. Then, commencing in 2016, it cut back its new mortgage originations, allowing 3 years of consumer paying down their mortgage debt, decreasing their loan-to-value ratios, decreasing CIBC bank share value, and the ignorance of the investor community to how you should read a Canadian bank's profit profile and its risk allows you yesterday, at the close of business days, to buy a share of CIBC stock that as of that day, for every $100 you invested, was going to pay you $6.79 in a return. Why is this not communicated to the public? I am not a stockbroker. I am not a financial advisor. We advise those people in terms of what our viewpoint is, and increasingly they are now coming to us seeking, I guess you could say, our opinions. I'm going to say our insights into how we rank Canadian banks and how we forecast their risk profiles. But why are we not talking about there? There's this rule. There's the rule called the 4% rule. And the 4% rule is this: if you got $1 million in retirement, you can expect to take out 4% of that, $40,000 a year, and your $1 million will never evaporate. The stock market will continue to allow it to turn over. Who in their right mind would not just simply go out and buy CIBC stock today when I get $68,000 a year guaranteed on my $1 million investment? When have Canadian banks over the last 40 years ever paid a lower dividend in a following month? When have dividends ever fallen? The actual dollar amount. Let's say that you believe in the 4% rule. That means over 2.7%, like 2.7% of over a third of the dividend now being paid. So if the bank cuts back the dividend, something it's never done in history, modern history, to 66% of what it is today, they cut it by 33%. You're still getting that 4% rule being met. There's virtually no risk in these things. Yet where are the financial experts debunking what I'm saying? Where are the financial experts not on the news today telling people, hey, you just watched your CIBC dividend go from 5.7% annually to 6.8% annually. If you invested $1 million as a retiree, you just got an extra $11,000 a year to spend. Why are they not reporting that? I have no idea, Jim. I have no idea if COVID-19 is the actual cause for a recession. All I know is this: in the late 80s, the mid 2000s, and just before and 3 years before 2020 started, the housing market signaled the Canadian economy was heading towards a recession. The volume, the magnitude, the size of the Canadian housing market means once it gets into this trajectory, it's virtually impossible to change. If it's going to be changed, it's going to change in the first 12 months. After that long, the housing market, you cannot reverse the ocean liner that is the Canadian housing market. Australia was the same. China was the same. Great Britain was the same. If I had reliable housing data for other countries, I probably could extrapolate whether or not it's the same for their countries as well. But those places, there is enough data available, USA, Canada, Australia, China, and the UK, Britain, that you know when these things are going to happen. We had a global housing correction begin in November of 2016. It is my belief that the Chinese government was looking for an excuse to get out of the mess that they're in, because they are in a major mess. You do not have 5 million vacant homes that have been leveraged not just on those 5 million homes, but leveraged by the multiplicity effect of home values. All of that leveraging has been done. It can't go on forever. As we've said on the show, it's a mathematical impossibility. The same thing as saying home prices are going to continue to increase 10% a year for the next 10 years. I will tell you that is impossible. It is impossible. It's a mathematical impossibility. I guess, unless wages in your country are going to go up 10 times as well. COVID-19 is the excuse for the recession that is probably going to be recorded Q1 2020, Q2 2020, 2 quarters. The economists claim that's a recession. If you go back to our recording back from March of 2016, we stated all GDP growth in Canada would be negative if you removed the impact of the wealth effect on GDP at that time. That was the first quarter where we believe Canada was already in a recession. We believe it has been recessionary the entire time. When you go and ask people, what if their wages changed in the last 3 years? Contrary to what the statistics say, most people are going to say their wages haven't changed at all. High-income earners may have changed, but the vast majority of Canadians haven't, unless there has been a change in minimum wage in your province, Ontario and Alberta. So let's leave this topic, Jim, with that statement. I believe economists around the globe are going to use COVID-19 as the excuse why they missed the oncoming recession, because they don't know how to measure housing market. They don't know how the wealth effect works. They don't know how house price illusion works. They don't understand how the cooperative listing service works. And the Bank of Canada, which just dropped rates 0.5 or 50 basis points, clearly is clueless. And POLAS is hoping to escape before that recessionary call is recorded.
We'll have more with Ross Kay right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're speaking with Ross Kay. Ross, can the government use the housing market to stave off a recession? And if so, at what cost?
Yes, for sure, Jim. They're trying to do it right now. They're trying to do it right now. Now, what they don't understand is that you can't keep doing it. So, in other words, the little bit of a delay that they got through 2019, it came at a tremendous cost to Canadians, and it's a cost that nobody even, you're not going to read it in a newspaper. You just don't read these things. I will tell your listeners that to stave off negative GDP growth in 2019 being recorded. In other words, in order for the government seeking to be reelected to not have a recession recorded in this country, they turned to the Canadian home buyer, the Canadian homeowner, and they said to them the following: we want you to borrow more money to spend. Because if you don't do that, we will be recording a recession. What we're going to do is we are going to totally reverse the decrease in mortgage debt trend, and we're going to start reversing it. We're going to start increasing it again. It was only, a year ago, where all the bond rating agencies around the globe were saying how Canadians were the most indebted people in the world, where the Bank of Canada was out there saying, Canadian home buyers are the most indebted in the world. They're so frugal, they're so imprudent with their decision-making process. The OSFI had to change the mortgage lending rules. What they don't say is that in the last month, the amount of mortgage debt being recorded has returned almost to the peak debt that was being booked back in 2017. So we have booked more mortgage debt. We are booking mortgage debt basically at the same rate as we were when every bond rating agency, every economist, the Bank of Canada itself, CIBC, the federal government, everybody was saying Canadians were booking too much mortgage debt, but they're right back at it again. And what they've done in the last week, Jim, is a blatant, outright disclosure of their modus operandi. They are saying this: we are going to lower the amount of mortgage interest payable in the first 5 years minimum of your mortgage term. We are going to do that so you will go out and buy a more expensive home. Not so you'll pay less mortgage debt, which is a falsehood, a myth. It's so that you will now go out and buy a more expensive home. When the group of buyers active in a housing market in a month are given more leverage on their income to spend more money using historical norms generations of Canadians have followed, they will spend more money because it has been proven for 40 years to be a financially prudent decision. Those buyers going out and buying more expensive homes are then in turn told, the rest of Canada is told, house prices have increased by your local real estate boards. Everybody believes it. When in fact, if a home buyer who yesterday was approved by the bank to buy a $100,000 house, today gets approved to buy a $110,000 house, goes out and buys a $110,000 house, a 10% increase in the purchase price paid. They buy a totally different house. They're buying a house that was $10,000 more expensive. If it was $1 million, it is $100,000 more expensive. It was a house that a day ago, when you were looking on Realtor.ca, that you didn't even look at because the bank wouldn't approve you for the mortgage. What the Bank of Canada did this week is unethical to the highest degree I can imagine. It's unethical because they didn't tailor their conversation to tell people the truth. I have no problem with their dropping their rates. I have a problem with them not disclosing the consequence of that decision. The consequence is house price illusion that will be immediate and it will be recorded. It will be recorded the same way that house price illusion this February was recorded in the Toronto Real Estate Board. There was not a 17% increase in house prices. If you do a granular search on any street in Toronto, you are not going to find housing prices. The same house is selling for 17% more this year versus last February. You won't find that. You're not going to find, in most cases, any house price change at all. It will be zero, which means in the way housing markets work, house prices are negative year over year. You may find one-bedroom condos in some buildings where they were selling for $450,000 last year, where some innocent young home buyers are being fooled into spending $520,000 this year because the incompetence of the real estate agents, the myths that are believed. But every other class of home, you're not going to find that change. What you're going to find is more expensive homes were being purchased. Those more expensive homes raise the average selling price because home buyers are spending more money. They're buying better homes. The Bank of Canada, without saying it, without disclosing it, without telling the public that right now Canadians are booking mortgage debt almost at a record pace. And based on the sales that have taken place over the last 3 months, when the first quarter housing market data, mortgage origination data finally arrives, which you won't see till September, it will probably be a record rate. It will probably surpass the amount of mortgage debt being booked in 2017. I won't know for another month whether or not that record's going to be broken for sure or not. Once those closings come in, then we'll know exactly where that number is going to be. The Bank of Canada didn't say that. Everybody in the world has laughed at Canada. They have insulted the intelligence of the Canadian family, being imprudent, financially irresponsible. We have read it in every newspaper in this nation for 3 years, how stupid the Canadian family is, because they spend too much money, when in fact, that's not actually the case. And the proof of that is the Bank of Canada, in cahoots with the federal government, is attempting to stave off a recession by asking Canadians to go out and borrow more money. It's not enough that they want to put a debt load on future generations of Canadians by running deficits, which is going to explode, by the way, folks. The deficit is going to explode because the false metrics of the housing market from 2019 are finally going to start being recorded in GDP data and in the government's own statement of adjustments. Those numbers are going to start to be showing up. They're asking Canadians secretly, without telling them, hey, go out and borrow more money. We're going to make it so attractive for you to go out and borrow a higher amount of mortgage debt that you're going to go out and do it because you know you can make the payment for the first 5 years that you're going to carry the mortgage. This is why Japan entered the situation that it did. Why have house prices in Japan not changed in 25 years? Why have house prices, even though the housing stock has been totally remediated over the last 25 years, increasing the quality of the stock, why have house prices not increased? Well, because when people can only spend a certain amount of money, they spend a certain amount of money. Why did Poloz not tell people earlier this week when they dropped the 50 basis points on which will end up coming on mortgage debt? Why didn't he tell people what we're actually doing is we want you to go out and borrow more money to stave off a recession. We want you to enter 25-year agreements to pay off mortgage debt, more mortgage debt than what we did yesterday. Why don't they disclose this? Where are the bond rating agencies out there today whining about Canada's cutting the interest rate? I don't know. I can't tell you why they don't do it. All I can tell you is you can't deny the math. You can't deny the reality. You can't deny what my eyes are seeing. You can't deny decades and decades of consistent consumer behavior and their impact on the economy. You can't deny it. Why did Poloz or Morneau not announce on the day that they dropped a 50 basis point drop in the mortgage lending rate, effective, that's what's going to roll out, the prime lending rate? Why didn't they announce what the real reason they're doing it for? The real reason is this. We want you Canadian families to go and borrow more money. We want you to borrow more money so we can fulfill our inept delivery of services to this country, of economic stimulation. We want to, once again, certainly prior to another election where because we've got a minority government, which could get dethroned any day, heading back to the polls, we want you to protect us. We want you to go out and borrow more money to save our jobs. And anybody who questions this only needs to look down in the United States of America. Because the realtor in the White House, as we talked about in last show, got what he wanted. He got the drop in the Fed. Canada responded identically. You've got a realtor in the White House who understands that unless the American public borrows more money, the house of cards will fall down. Canada is identical. Unless Canadians keep going out borrowing more and more money. And I have to express it. It has to be at an upward swing. You have to keep, you can't keep borrowing the same amount each month. You have to keep borrowing more each month or the house of cards falls down. Bank of Canada has its own data that goes back decade that verifies what I'm saying. I don't know why they can't read it themselves.
We'll have more with Ross Kay right after this.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ross Kay. Ross, one of our listeners wants to know, with very low interest rates right now, is this not the best time ever to buy a house?
Okay, so great question, and this is the confusion that every home buyer in Canada has, because they're working in an infrastructure that was not designed to support them. Falling mortgage rates are one component of the cost of owning a house over the first 25 years that you're going to own it. It is a very big, historically, it's been a very big cost. It's lesser now because of these falling interest rates. You have to know the difference between the price that you're purchasing and the mortgage interest that you're going to have payable. You have to also understand the particular house that you're looking at acquiring, what it's going to cost you to own over the next 25 years. The market that you're looking to buying in. Okay, it might be okay for you, but if there is not a profile, if the demographic profile in the area that you're buying does not support future house price gains, the same as if you just move over a town, the cost of owning in the community that doesn't favor your house price gains is actually higher. So what seems to be a simple answer, hey, I can save, my mortgage is going to be 10% lower, for the sake of the argument, which is because we will see that. So within the last 2 months to what we're going to see in the next 2 months, you're going to see at least a 10% drop in mortgage payment costs. You have to look at the price of the house. And, I think what has happened, Jim, is because once rates drop below 7%, the importance of house price, the relationship between house price and interest rates, began to lessen. And people didn't really understand, what it's like to have a 10% mortgage. People don't understand what it's like on a $100,000 mortgage to have to pay $10,000 a year in interest. $100,000 today, you can have as low as $2,000 a month in interest as of this morning. So in other words, the best rates that we're seeing right now, we see a 5-year rate at 1.99%. Okay, 5-year rate at 1.99% is $2,000 per year. In the first year, it's not that amount, but I'm just rounding off to make things easier. It's going to cost you $2,000 a year for a $100,000 mortgage. When rates are 10%, it's going to cost you $10,000 a year, 5 times more. And then we hear these silly comments about affordability. If I'm paying 5 times more the interest per $100,000, I believe that is a cost of ownership. That goes into affordability. House prices, mortgage rate, the remediation costs in the home that you're going to buy, maintenance costs in the home you're going to buy, renovation costs in the home you're going to buy, demographic profile of the neighborhood you're going to buy, the class of home that you're going to buy. In other words, what class of home are you currently, what step in the property ladder are you taking right now? Because house prices do not increase the way that you've been led to believe. A 10% house price increase does not mean all the homes in the neighborhood go up 10%. It means certain classes of homes go up 15%, other classes go up 10, other classes go up 5. That's what it means. You can't find that in print anywhere. But that's really the answer to this question. Your situation is unique. You simply need to have the facts laid out before you so you can make a rational decision whether or not now is the right time to buy. Your timing should always be of this one priority. What is the lowest 25-year ownership cost any home is going to result in you paying. If you can lower that ownership cost, you're saving money. If you're buying a home that increases that ownership cost, you're losing money. That's okay as long as you understand what you're gaining or losing for that money that you're overpaying or underpaying for, the home you're underpaying or overpaying for. The answer is too complicated to give here on the show, because if this is the questioner is someone that has a 60% down payment, in other words, they've already owned homes for 12 years and that they're making their next big step up the property ladder into an executive class home, maybe the answer is yes. If you're a first-time buyer who's going to have 95% mortgage, maybe the answer is no. If you're a brand-new condominium buyer who's buying a brand-new condominium in a city where the building standards and then the environmental standards are not going to add future costs to your ownership, unplanned for costs, or if you have planned truthfully for the costs, then you can make a rational decision on that answer. The complicated process of deciding or of answering this question is really quite simple, but you have to put all of the components together. You have to understand how they all interact, and you have to come up with a number. Organized real estate can't sell real estate that way. You can't price a home at $500,000 and another home at $500,000 with not understand and disclose to the public, but this other home is going to cost you an extra $100,000 to own over the next 25 years. You're never going to sell that other home. The level of education, experience, knowledge required to deliver that answer is beyond everything that organized real estate is built upon. It is not taught in a single real estate training course. It is not taught by any provincial regulator. It is not available in any book because people are too busy selling. The people who maybe have the ability to answer those questions are too busy making money, selling dozens and dozens and dozens of houses a year. They're not selling 1, 2, 3, 4, 5, 6 houses a year. They're selling dozens and dozens and dozens, because the only way you gain enough knowledge and experience to understand that is to do that over several decades, which virtually never happens. Virtually never happens. There would be less than 0.02, maybe 0.002% of all realtors in the marketplace who will ever reach that level of experience. So, to answer the question, you need to understand what the 25-year cost profile is for any home you're looking at buying and from that, only you can make a rational decision whether or not that's in the best interest of your family. If it is, move forward. If it's not, wait. You should also have a 25-year cost change, because as the housing market moves, prices go up and down, your cost goes up and down. Because if your home goes up in value more, your cost is less. Because even though you're paying $2,000 in interest, if your house goes up $2,000, hey, you're virtually a break even. You need to have that information to make your decision, and for me to answer that question. What I will say is, we are now back to the lowest mortgage rates ever possible in this country. As of earlier today, I saw another 1.99% mortgage for 5 years. I had only seen that once before in the last 40 years that our data covers. The last 30 years that I was actively selling homes, I only ever saw that happen once before. That opportunity is rare, but you have to remember, when a bank tells you can spend $10,000 more, you're going to spend $10,000 more. You're going to buy a $10,000 more expensive home. You're not going to buy the $100,000 house. You're going to buy the $110,000 house. Because a $110,000 house, the bank is telling you, is going to cost you exactly the same as a $100,000 house would have a day ago. Get the data, get the information, demand that you're told these things, and then you make the decision on your own.
Ross, thank you so much for being on the show.
Thanks for having me back on, Jim.
My guest has been home ownership consultant Ross Kay from the wealthyhomeowner.ca. If you have any questions for Ross, you can send them to info@housestreet.com. Find us on Twitter @HouseStreet. Our YouTube channel is Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.